Good. So we are on the balance sheet for this question, the balance sheet. So back to the question. Just a quick one so you can move along with me. This is the format of the balance sheet that we have discussed in the last class. So quickly, you begin with the fixed assets, followed by the current assets. You less your current liabilities, and then that will give you your working capital. I'm just mentioning them to click them in your memories. Okay, so here comes the format. After the title, the first thing is the fixed assets. The fixed assets. So for this question, we'll go and pick our fixed assets. Okay. So this one you try for me. I'm having 3 strong ladies, and I'm the only gentleman here. So my ladies, let's go through the question and pick out the fixed asset. If you are ready, you can give me your first fixed assets, or you want me to call your name before.
Furniture and fitting.
Okay, thank you very much. So the first one she has mentioned is furniture and fittings. But again, Mamia and Jacinda have their hands up. Let me go with Mami first. Then Jacinda will follow second. So Mami.
Motor vehicle.
Motor vehicle, thank you. Jacinda, do you have one to add as well?
No, please.
Okay, so that is all. So when you go through the question, capital, debtors, creditors, bank, sales, purchases, opening stock. The first one is the motor vehicle. And then the second is the furniture and fittings. If you continue, you have wages, rent, blah, blah, blah. There's no other fixed asset except these 2. So we have the motor vehicles and then the furniture, as somebody will say, furniture and fittings. Okay, so furniture and fittings. Now again, this is a question where we don't have depreciation, so don't bother yourself about the cost, depreciation, and whatever. So you put the figure straight under the third column. Motor vehicle is let me trace the figure well, 42,650. Good. And then the furniture and fittings is 8. Am I missing this? Okay, this purchases opening stuff. Okay, furniture and fittings is 8,190. Okay. So these are the only fixed assets you have. So you can put the total there so that you get your total fixed assets. So let me do the addition here for us. So 42,650 plus 8,190. That will give us 50,840. So we can call that the total fixed assets. Good. So that's the first thing you do. If you move on to the format, after the fixed asset, the next one is the current asset, right? So let's familiarize ourselves with the current asset before we move on. So current assets, we have the stock, which is the closing stock, debtors, bank, prepaid expense, accrued income, and then cash. Okay. So let's check the question, which ones we have available there. Here again, my beautiful ladies are going to do that for me. So current assets. Ladies, what do you see as current assets in this question? I'll start from the Roman, is it Roman sister or Reverend sister? Reverend Sister Benedicta Oforiwa.
Debtors.
Okay, so we have the debtors in here. Thank you very much. So you really, no, hold on. Let me speak about. Really, you want to be a Roman sister or a Reverend sister?
No, please.
Thank you very much. Because I know that is not part of the deal. Thank you. Mami, apart from debtors, what else do you see as current asset?
Bank.
Bank, okay. Jacinda, add yours.
Can I add closing stock?
Yes, the closing stock, of course. So now let pay attention to this. You see how the assets, the current assets have been arranged. You start with the stock first, followed by debtors, followed by, in fact, the prepaid expense and accrued income should come before the bank and cash. So pardon me for the arrangement error here. So it's normally stock, debtors, prepaid expense, accrued income, then bank and cash. We arrange them in that order to, back the fact that some of them are more liquid. And I'm going to explain further what I'm saying. You see, current assets, these are assets that should be converted into cash easily within one financial year. So they are current assets because we expect that by the end of the year, they'll be turned or they'll be converted into cash. So if we say an asset is more liquid, it means it can easily be turned into cash. It is liquid. So if you look at the asset here, the one that is more liquid is the cash itself because it's already in cash. Followed by bank, simply because when you go to bank, you can easily withdraw cash. Prepaid expense, accrued income, you can also easily recover cash from them. For instance, if you have prepaid rent, you can go to your landlord and say, please, I need my money, and you get a cash. Debtors, you can easily get cash from debtors. You go to them and you say, oh, okay, please bring my money. But it may drag small compared to when you go to the bank. If somebody owes you and you go to him, the person can tell you next week, or the person can give you check and you have to go to the bank to withdraw. So look at the process. But if you go to the bank straight away, you get a cash. So you would see that bank is more liquid than debtors. The same way, debtors is more liquid than stock, simply because with the stock, you first need to sell it. So you will need a customer to buy the stock. That's number one. This customer may not pay instantly, so you will not get the cash there. This person will pay it later. And the person can even give you a check and you have to go to the bank. So stock is the less liquid current asset. What it means is that it is not easier to convert stock into cash because you have to sell it. The person will not pay. He'll give you a check before you go to the bank to cash it. But if somebody is owing you, you go to him, the person can give you cash. Okay. So the arrangement is done in an ascending order, looking at the one which is less liquid. That is the one which is difficult to turn into cash, followed by the other in that order. So I always advise my students, when you are bringing your current asset, use that level of liquidity, okay, how liquid the asset is. So always ensure that your stock comes first. So the stock, which is the closing stock, is what you bring in there, followed by the debtors, followed by the prepaid expense, accrued income, and then the bank, and finally the cash. So let's check this question. As you have rightly mentioned, we have the stock here, which is the closing stock. So we put that at the middle column, the current asset, you put them at the middle column. So the stock, which is 42,000. Don't make a mistake of bringing the opening stock here. It's always the closing stock. Then the next one is debtors. So debtors figure, as we were given in this question, is 66,000. If you have a question, you can ask me though on what I just said about this liquid assets and all. Okay, I believe there's no question. After debtors, you look out for prepaid expense and prepaid income. My dear students, those things normally appear in the additional information, what we refer to as the adjustment, and we are yet to go there. So in this question, you will not see any prepaid expenses here. No. So the next thing will be the bank. Let's check if we have bank. Yes, we have bank at the debit side. So bank, which is 99,870. And finally, the cash. So cash, do we even have cash in the question? 1, 2, 3, 4, 5. No, we don't have cash in the question. So these are the only current assets in this question. So let's get the total. So total current assets. So you put that total just under the assets you have listed, the current assets you have listed, I mean. Okay, so let me use Excel to calculate this. 42,000 plus 66,000 plus 99,870. We have 207,870. So that is the total current asset. So again, back to the format. After listing your current asset, the next thing is to list the current liabilities. So after your total current assets, you less the current liabilities. And again, let's look at the liabilities. We have creditors, bank overdraft, expenses accrued, and income prepaid. Again, the last two are not in this question because we don't have any adjustment or additional information. Okay. So let's watch out for creditors and any bank overdraft. Bank overdraft is a bank which has a credit balance. So pay attention to that one as well. So in this question, let's see. Yes, we have the creditors. So you see creditors at the credit side. Creditors at the credit side. That is 48,370. Let's check if we have any bank overdraft. The bank we have here is a debit balance, so it's not an overdraft. If it's an overdraft, it will be at the credit side. Okay. So we don't have bank overdraft. We only have the creditors and no other liability. So let's do that. Less current liabilities. And here we have only creditors. So normally, if it is 2 or more, you would have listed them here, and then the total will come here. But because it's just only creditors, only one item, we can push it straight and less it from the current assets. So 48,370. And I told you something last time that total current assets minus current liabilities will give you something we call, well, I'll visit you in your home when you turn age 95. Hi. Total current assets less total current liabilities is going to give you what?
Working capital.
Thank you very much, Jacinda. You just want yourself a visit when you turn 95 years on planet Earth. I say, I'm not a ghost, dear. So you want a ghost to visit you. Okay. So the working capital is what you push under the third column to be added to the total fixed assets. Okay. So your total current asset minus your total current liabilities, you get your working capital. So you see where the working capital is and the third column so that we can add to the total fixed assets. And the figure we are going to get would be called the net total assets. So let me do the addition. 50,840 plus So I'm going to get 210,340. So the net total assets gives you the first section of your balance sheet. So you underline it twice. So the first section is very simple. Please pay attention to it. Bring your fixed asset first, followed by your current asset, less the current liability so that you get working capital. Add it to the fixed asset, and then you have your net total assets. Okay, so let me again bring back the format. So as you see on my left hand side, your working capital added to the fixed asset, which is up there, you get the net total assets. So what is now left is for us to look at the financed by. Okay, so financed by. And under the financed by section, you only pick your capital. So look at it here, capital. Then you go back to your profit and loss account and check whether you had a net profit. You add it. If it is a net loss, you less it. And also check the question for drawings, if the owner made any drawings. So let's do that one. We are going to look for the capital. We already had our net profit, and we also check for any drawings. So capital, let's check the question, and it's in the question, I believe. So yes, this is capital, 132,000. So that one, don't worry yourself, just put it at the third column, 132,000. Good. Then in this question, we had net profit. So let's check. Yes, we had a net profit of 135,640. So we are going to add that 135,640. So we add the net profit of 135,640. Then you also check for the drawings in the question. So if you check the question, you can see drawings here, 57,300. So we less the drawings, 57,300. Okay. So you do that to get what we call the net capital, or you can call it the closing capital. So let's do that calculation and see. It's equal to the capital plus, because we are adding the net profit, minus the drawings. So we have 210,340. Don't be quick to finish. Check the format. You see that after getting the net capital, you need to add long-term liability, which is the bank loan. So you check the question for a loan. So let's check this question if we have that. In this question, loan is a liability, so it should be on the credit side. Loan, there's capital, there's creditors, there's sales, there's discount received, there's return out. So we don't have any loan. So there is no long-term liability. So this closing capital becomes your capital employed. So this is the closing capital, or the capital. And if you are paying attention, you would see that the net total asset is equal to the capital employed. And in your balance sheet, those two figures should always be equal. Otherwise, there is a problem. So your net total asset should always be equal to the capital employed. And God being so wonderful, in our case, the two figures are equal. So our balance sheet has balanced. And that is all for the balance sheet as well. So just to add, if there was a long-term liability, you'd have written long-term liability. And for a sole trader, it is loan, bank loan, which you will see it at the credit side. So you write your loan and then add the figure to it. And whatever you get will be your capital employed. I want to believe my students are okay. If you are confused, let me know. For Nana, you just joined, so you may be confused, but I'll put the video on the page for your use. So any question, Jacinda, Mami, and Ofoiwa, any question on the balance sheet?
No.
Okay, no from Mami, yeah. I guess no from Jacinda, and then no from Ofoiwa as well. Okay, Nana, you have a question? Because you are not here fully.
No, please.
Okay, so I'll put the video on the page so that you can watch it and follow through to familiarize yourself with the balance sheet. So my beautiful ladies and gentlemen, this is where we draw curtains on this balance sheet, TPL and whatever, but we are moving to the adjustment. So quickly, I'll introduce that. I think we would have some 30 minutes. The class is supposed to end at 11:30, so we'll have some 30 minutes after this second break. Please join so that we continue. If not, then I'll give an assignment or an exercise. So which one do you prefer? We rejoin to continue the adjustment, or you take an assignment? Let's vote. So Jacinda, what are you going for? Rejoin for the adjustment, or you take an exercise?
How we do both?
Okay. So Jacinda wants both. Oliver Twist asks for more. Mamiya, what is your verdict?
I don't really know.
Mamiya is acting like a confused Nana Akufo-Addo, Dankwa Akufo-Addo, and Bawumia. Then what is anyway, those who are not confused, just that the economy in Ankasa, all of us, including yourself and myself, we need to start thinking outside the box. We can't blame just the politicians. We are all part of it. Okay, so let's go to the adjustment. Now, my dear student, you see what we have done? We have been able to prepare trading account, profit and loss, and balance sheet. But the point is that sometimes there are some mistakes that you need to correct. There are some things you left out that you need to bring in. Okay, so it can happen that, oh, at the end of the year, you forgot that, oh, you sold goods to Ancharaba who didn't pay. So you now remember and say, okay, I need to effect this in my account. So that's the essence of the adjustment. The adjustment are corrections or additional work you have to effect in your final account. Okay, so that is just to whet your appetite for this adjustment that we have to do. So let me cite an example. It is possible that you come to school, or when you go to school, you are preparing your account. So you check, oh, pocket money, 50,000 Ghana cedis. Then you remember that, oh, your auntie promised that she was going to also send 5,000 Ghana cedis as pocket money. So you see that you cannot report the 50,000. You have to report 55,000. Okay. So the 5,000 which you forgot and have now remembered, you have to adjust it in the accounts you are preparing so that you give the true and fair position of your pocket money. So that's the essence of the adjustment. So let me read here, and I believe all of you can see. Adjustments are corrections or additional work that is effected in the business final account or in a business final account. So corrections, it can happen that you made a mistake. Your sales figure is 50,000 and not 55,000. So in preparing your final account, you have to make that correction by way of doing an adjustment. Okay. If you are doing adjustment, you have to make some entries. So you'll be doing some debit and credit, and those are called closing entries because you are doing them at the end of the period. So closing entries, these are entries or journal entries made to move temporary account balances to permanent accounts at the end of the accounting period. So let me give you a clue like this. You remember in Form 1, you were doing a lot of T account. You open one account for rent, you open one account for Kojo Mensa, you open one account for cash and all that. Yes. Some of these accounts are temporal, like the expenses and the income. So the rent, insurance, telephone, all those things. At the end of the year, you have to close them into a permanent account. And that permanent account is the profit and loss account, where you compare these income to the expenses to get the profit or loss. So that's the essence of closing entries. My dear student, we have to go through 10 adjustments. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Trust me, they are very easy, but they are also tricky. So meet me in the next session and let me take you through adjustment. And by the time we finish, I know some of you will be making adjustments. You don't want to think about becoming a bachelor or a reverend sister or getting married or becoming a pastor instead of an accountant. Okay, so see you.